Welcome to the Deep Dive, where we unpack complex information to give you the essential insights. Today, we're plunging into the recent NextEra Energy Inc. second quarter 2025 earnings call.
Right. Our mission today is really to distill the most important nuggets from this significant earnings report. We want to help you quickly grasp the key financials, management, strategic outlook, and, the broader implications for the energy sector.
Yeah, cut through the noise, basically.
Exactly. Deliver clarity and context, and we'll explore why the market reacted maybe a bit cautiously despite some really robust numbers.
Okay, so kicking things off with those headline numbers. NextEra Energy delivered a remarkably strong second quarter. We saw adjusted earnings per share climb, 9.4% year over year? Pretty impressive.
Very solid. And if you look at the first half of the year overall, adjusted EPS kept that momentum going, showed a solid 9.1% increase compared to last year.
But you mentioned the market reaction. Bit more cautious.
Yeah, that's right. While those numbers certainly reflect, powerful performance, the sentiment after the call wasn't quite as enthusiastic. So this deep dive will explore exactly why, look at both the underlying strengths and the challenges management discussed.
Get that balanced perspective.
Precisely. It's this nuanced interplay, really, between predictable regulatory returns from FPL and the unpredictable yet high-growth world of renewables with energy resources.
All right, let's unwrap those financial drivers then. Let's start with Florida, Power and Light, FPL. That's their regulated utility arm. It contributed positively, right? What was really fueling that steady growth?
Well, the principal driver for FPL was significant regulatory capital employed growth. It expanded by nearly 8% year over year.
Okay, what does that mean exactly? Regulatory capital employed.
Essentially, it means FPL is steadily expanding its rate base. That's the value of assets it's allowed to earn a return on. So it ensures consistent, predictable earnings. Very stable.
Got it. So they're investing.
They are. Capital expenditures for the quarter at FPL were about $2 billion. And for the full year, the 12 months ending June 2025, they expect capital investments between $8 billion and $8.8 billion.
And their return?
Their reported return on equity for regulatory purposes came in at a healthy 11.6%. They also strategically used about $19 million of reserve amortization. They still have a balance of roughly $254 million there.
So the takeaway is steady, predictable returns.
Exactly. The real insight here is FPL isn't just growing. It's meticulously leveraging that stable Florida regulatory environment to secure predictable returns. It acts as a crucial bedrock, really, for NextEra's more ambitious ventures in energy resources.
Okay. And when we look at FPL's customer demand, what did the sales figures tell us?
Sales were solid, too. FPL's second quarter retail sales increased 1.7% from the prior year. That's primarily driven by continued strong customer growth. Florida's population just keeps expanding, and so does the demand.
Makes sense. What about usage per customer?
Overall usage per customer actually grew by 0.1% year over year, which is interesting because that happened even with a slight decline, about 0.8%, because the weather was milder.
Oh, so weather adjusted.
Right. On a weather-normalized basis, FPL grew retail sales by roughly 2.6%. That's quite a strong underlying demand story, really.
Okay, so FPL is ticking along nicely, delivering stable results.
Yeah.
What about NextEra Energy Resources? That's the renewable energy and infrastructure development arm. How did that segment perform? It's usually more volatile, isn't it?
It can be, but it really stood out this quarter. Energy Resources reported an adjusted earnings per share increase of 11 cents year over year. Big driver there.
And what caused that jump?
It was largely driven by robust contributions from new investments. Those added 14 cents per share, primarily from the continued pretty aggressive growth in their renewable and storage portfolios.
Sounds like a powerful engine for growth then. But was it all sunshine for Energy Resources? Any headwinds?
Not entirely, no. Their existing clean energy portfolio actually saw a small decrease, about 2 cents per share.
Oh, why was that?
It mainly reflected weaker wind resources during the quarter. To put it in perspective, wind resource for Q2 2025 was about 97% of the long-term average. That's down from 104% in Q2 of 2024.
Right. So natural variability plays a part.
Exactly. Even with a diversified portfolio like theirs, weather happens.
Okay. Beyond just the quarterly numbers, what about the pipeline? The origination figures. That's where the long-term story often really shines.
Absolutely. And Energy Resources had a truly phenomenal quarter for new renewables and storage origination. They added an astounding 3.2 gigawatts to their backlog.
3.2 gigawatts.
In one quarter.
In one quarter, yeah.
Right.
To give you a sense of scale, with these additions, their total backlog now stands at nearly 30 gigawatts. And that's after placing over 1.1 gigawatts of new projects into service since the last call.
That's huge momentum.
It really is. This marks the 6th time in the past 8 quarters that Energy Resources has added more than 3 gigawatts to its backlog. Over the last 12 months, they've accumulated about 12.7 gigawatts of new projects.
Wow. And what's particularly striking, and this is a really significant insight, roughly 30% of their current backlog now comes from storage.
30% storage.
Yeah. It demonstrates incredibly strong customer demand for these low-cost, ready-now capacity solutions. Storage is becoming a real game changer.
So looking at the consolidated picture, NextEra overall, how does this quarter fit into their broader long-term financial expectations? Are they still feeling bullish?
Management stated their long-term financial expectations remain, well, rock solid, unchanged. They anticipate delivering results at or near the top end of their adjusted EPS expectation ranges for 2025, 2026, and 2027.
So still very confident.
Very. They also expect average annual growth in operating cash flow to be at or above their adjusted EPS compound annual growth rate. That's the average annual growth over time from 2023 to 2027.
And dividends. Always important for investors.
Right. They committed to continuing growing dividends per share at roughly 10% per year through at least 2026 off the 2024 base. So, yeah, strong confidence signals all around.
Okay, beyond all those impressive numbers, management painted this picture of a truly unique and transformative moment for the entire energy industry. What exactly is driving that perspective?
Well, think about it. For decades, electricity demand in the U.S. was largely stagnant, right? Flat. But now it's a completely different story. They're seeing significant growth across all sectors.
Not just the headline stuff like AI.
Exactly. While artificial intelligence and the reshoring of manufacturing grab headlines, and rightly so, I mean, these massive data centers demand incredible amounts of power. The demand for more electricity is also surging from residential, commercial, industrial, even oil and gas sectors.
Interesting.
Yeah, a recent ICF study highlighted this. It expects demand growth over the next decade to exceed the last 3 decades combined.
Wow, that's a huge shift.
It is. The message from next year's leadership is crystal clear. America needs more electricity, and frankly, it needs it now.
So how is NextEra positioning itself as a leader to meet this unprecedented demand? What's the strategy?
They're firmly aligned with this goal of unleashing American energy dominance. They're emphasizing the urgent need for all available electrons on the grid without delay.
Getting power online fast.
Right. Customers are actively signing contracts for new energy infrastructure precisely because NextEra can build it quickly and at a low cost. Management stresses they'll need all forms of energy.
The all of the above approach.
Exactly. New gas and nuclear for the long term, sure, but renewables and storage can bridge the gap and play an absolutely critical role right now. They aren't picking favorites. They're focusing on what works to get power online reliably and affordably.
You mentioned storage again as pivotal. Why is it so crucial in this picture?
Well, storage is highlighted as low cost, incredibly versatile, meaning it can be charged by pretty much any energy source, solar, wind, traditional generation, and it's absolutely crucial for grid capacity and stability.
And flexible too.
Very flexible. It can utilize excess transmission capacity, and critically, it can be deployed quickly, exactly where customers need it most. Renewables combined with storage are ready now. They provide much-needed electricity and capacity far faster than building new traditional generation.
Like a rapid response team for the grid.
That's a great way to put it, yes.
Okay, while the demand story sounds fantastic, there are always challenges. What are the key regulatory and policy hurdles NextEra has to navigate? It's never a completely smooth ride in energy, is it?
No, it isn't. The environment is certainly challenging, and that's partly behind that market caution we mentioned. Now, a major piece of legislation, the One Big Beautiful Act, or OBB as they call it, did provide some crucial long-term certainty.
How so?
It phased out wind and solar tax credits over time, which gives predictability, and gave a longer runway for nuclear and storage credits.
Yeah,
but
there's always a but.
Right. The company has to manage this against a backdrop of ongoing executive orders, agency rulemakings, tariffs, trade actions. It's a complex dance, you know?
Despite those risks and complexities, NextEra seems incredibly confident. What gives them that edge? Why do they think they can navigate it better?
They believe they have significant opportunities because of the proactive steps they've taken over years. This includes being in a constant state of construction, basically. They made substantial financial commitments to start renewable projects way back, enough to cover their plans through 2029, even before OBBB was enacted.
Planning ahead.
way ahead. They boast this massive pipeline of early and late stage projects, what they call the best supply chain in the sector, and they're leveraging AI across their business, everything from optimizing power plants to finding new customers.
So it's about execution at scale.
Exactly. This isn't just about planning. It's about having the resources, the experience, and the scale to actually execute.
Okay, let's drill down again into Florida Power and Light. What's their specific blueprint for continued success down in Florida?
Well, FPL continues to benefit tremendously from Florida's constructive regulatory and legislative environment. It consistently supports infrastructure investment for the state's booming population. You know, the Florida Supreme Court recently affirmed their 2021 settlement agreement, which provides a really solid foundation.
So stability helps. What's the focus?
FPL is relentlessly focused on investing in infrastructure, maintain high reliability, keep bills low. They operate the nation's largest gas-fired fleet alongside 4 nuclear units in Florida. That diverse mix gives them the flexibility to seamlessly integrate cost-effective solar and storage.
More solar and storage coming.
Big time. Aggressive plans to add more than 8 gigawatts of solar and battery storage by 2029. The strategy isn't just about growth, it's about securing Florida's energy independence, improving reliability, and, delivering energy when customers need it most.
And speaking of bills, what's the latest on their proposed rate adjustments? That's always sensitive.
It is. FPL initiated its 2025 base rate proceeding back on February 28th. They proposed a pretty transparent 4-year plan, and their typical residential bill, it currently remains well below the national average.
And even with the proposed increases.
Yeah, here's an interesting point. Even with the proposed adjustments, it's expected to be approximately 20% below the projected national average.
Okay. What's the timeline on that?
There's a technical hearing at the Florida Public Service Commission scheduled for August, with a final decision expected in the 4th quarter. If it's approved, a typical FPL residential bill would grow at an annual average rate of just 2.5% from 2025 through 2029.
And are they open to settlement?
Management said they're always preparing rigorously for hearings, but yes, they remain open to settlement discussions if it makes sense for customers. They've successfully settled the last 3 rate cases that way.
Okay. Let's transition back to NextEra Energy Resources.
Yeah.
What's happening outside Florida, especially in those new high-growth areas like tech?
Right. Energy Resources continues to solidify its position as the nation's leading energy infrastructure developer. And here's a surprising fact. They originated over 1 gigawatt of new projects specifically serving hyperscalers.
The huge data centers for AI and cloud.
Exactly. Their backlog alone now includes roughly 6 gigawatts of projects intended just for technology and data center customers. And if you add their operating portfolio, they'll have over 10.5 gigawatts serving these specific customers across the U.S.
That's a massive focus on that sector.
It's a huge and rapidly expanding market, and they're clearly targeting it.
That's remarkable. Now, beyond renewables and storage, what's the latest on nuclear and gas? You mentioned all of the above.
Absolutely. They're really leaning into it. NextEra is making significant progress toward potentially restarting their Duane Arnold nuclear facility. That's a unique opportunity because it avoids the massive costs and timelines of building new nuclear.
Right. Restarting is different from new build.
Totally different. And they're also actively working on new gas-fired generation opportunities, pursuing both new builds and evaluating market acquisitions of existing gas plants. They're focusing on opportunities where near-term contracting makes immediate economic sense.
Where is the demand for gas strongest?
They highlighted that demand for new gas generation is seen across the country, really, though, some states are certainly more accommodating for getting things online quicker than others. Permitting varies.
It sounds like an incredibly broad strategy.
Yeah.
Are there any other areas of growth that stood out? Anything less obvious?
Yes, actually. Another fascinating area is how they're essentially building what amounts to a standalone rate-regulated utility within Energy Resources itself. It's called NextEra Energy Transmission.
And transmission business.
Exactly. A competitive transmission business.
Yeah.
This allows them to build more critical transmission infrastructure, the poles and wires, to efficiently bring power from those new generation plants to the communities and businesses that need it. It's a foundational piece, often overlooked, but crucial for growth.
Okay, a key topic during the call, and maybe a bit complex, was these safe harbor provisions related to the OBBB legislation. How does NextEra navigate potential regulatory changes there? Can you break that down?
Sure. Think of safe harbor like a grandfather clause for the tax credits. The OBBB mandates that wind and solar projects must be placed in service by December 31st, 2027 to get the full credits.
Okay, a deadline.
Right. But there's a critical exception. Projects that began construction before July 4th, 2026 are not subject to that 2027 deadline. They get more time.
So begin construction is the key phrase.
Precisely. And NextEra emphasized that begin construction has a settled meaning based on long-standing Treasury Department guidance that the whole industry has relied on for years. This definition, they assert, is entirely consistent with the OBBB law itself.
So they've acted on this already.
Oh, yeah. They've made significant financial commitments based on these rules, essentially starting construction on enough projects, they believe, to cover their development plans all the way through 2029.
So they feel protected past the deadline.
They express strong confidence in their interpretation, yes, though of course lawyers always say, no guarantees. But strategically, this isn't just about tax rules. It acts as a kind of bottleneck.
How so?
It favors deep-pocketed players like NextEra who could afford to make those early commitments. It potentially sidelines smaller competitors who couldn't, consolidating market power.
Interesting angle. Now, there was also talk about potential impacts from recent executive orders, specifically on federal land permitting. How does that factor in?
Right. An executive order on July 7th directed the Department of Interior not to sort of favor wind and solar projects in permitting. It adds another layer of review.
More red tape.
Potentially. It's a new dynamic, and they said they're actively working with the Department of Interior on it. But importantly, most of NextEra's backlog projects, the ones already planned, have already secured their federal permits.
So less impact on the near term.
They express confidence in their ability to navigate these issues, largely due to their experience and the fact that many key projects are already permitted.
Okay. Management also talked about a natural pull forward of demand because of these dynamics. What does that mean for NextEra? Sounds intriguing.
It's quite clever, actually. Customers are still figuring out the full implications of OBBB, right? But NextEra expects these natural breaking points, like the deadlines, to create significant opportunities for them.
Like the 2027 deadline.
Exactly. That placed in service requirement could accelerate projects as customers rush to meet it. But maybe more importantly, the whole situation heavily favors large developers like NextEra.
Because they safe harbor.
Because they safe harbor projects effectively, and because they're already in what they call a perpetual state of construction. They anticipate less competition in 2028 and 2029 from smaller developers who maybe lacked the balance sheet or the construction financing to safe harbor projects back in 2025 or early 2026.
So bigger opportunities for NextEra later on.
Potentially, yes. Larger market share capture. Management noted that historically, uncertainty, risk, and complexity have actually favored their business because they have the scale and expertise to navigate it effectively.
And maybe pick up projects from others.
They even see potential for opportunistically acquiring projects from smaller developers who might struggle to get them across the finish line in this environment.
Right. This brings us to that bigger, often debated question. The idea of a cliff. Demand falls off a cliff as tax credits phase out. How did management address that perception?
They pushed back hard on that idea, really strongly. They stressed that while tax laws, they may change, the fundamental demand for electricity is robust, persistent, and actually growing strongly.
The demand driver is key.
Absolutely. Customer dialogue for energy infrastructure, they said, is as strong as ever, extending well past the end of this decade. Their job, as they put it, is simply to build the energy infrastructure the country needs, regardless of changes in rules. It's a powerful message. The demand isn't going anywhere.
Makes sense.
And they also highlighted their significant pricing advantage in power markets. Remember, renewables are fast to build 12 to 18 months typically. And with their huge existing inventory of early and late stage projects, they feel they have significant pricing power and a clear cost advantage over building other resources right now.
And the existing fleet.
Good point. Don't forget the embedded value there. As older power purchase agreements, those long-term contracts roll off, they can recontract that power into the new, often higher-priced power market. That unlocks additional value from assets they already own.
Okay. And how does all this connect to broader market signals, like the recent PJM capacity auction results?
Right. The PJM capacity auction, where utilities in the Mid-Atlantic and parts of the Midwest secure their future power supply, sent a pretty clear signal. New build gas prices are needed to incentivize generators to build new plants.
So the market needs new generation.
Exactly. Management emphasized that existing assets are already there, running to accommodate today's demand. The capacity market is trying to send a price signal to incentivize new generation that doesn't exist yet. And building new generation requires specific development and construction skills.
Which plays to NextEra's strengths.
That's their view. They see themselves as uniquely advantaged here, having built continuously for the last 2 decades with a development team spanning, 49 states. They firmly believe the country needs new incremental generation. Existing infrastructure just isn't enough for future demand. It's a challenge, but one they feel uniquely positioned to tackle.
All right. It's time for our This Is Not Financial Advice segment. This is where we pitch an outrageous but plausible trade idea based on today's deep dive into NextEra Energy's call and strategy.
Okay, let's try one. Given NextEra's, unique positioning, especially with that surge in data center demand for AI and their very comprehensive all of the above energy strategy, here's a thought. Consider taking a long position in NextEra Energy, NEE, but simultaneously shorting a carefully selected basket of smaller, less diversified independent power producers, maybe ones focused purely on renewables.
Okay, long NextEra, short, smaller, pure play renewables. What's the thesis?
The core thesis is that NextEra's, frankly, unparalleled balance sheet, their deep supply chain, their proven ability to navigate complex regulatory stuff like the OBBB safe harbor rules, and shifting federal permitting will allow them to capture a disproportionate share of the market, especially in this rapidly growing but increasingly challenging energy landscape.
And the smaller players get squeezed.
Potentially. Smaller players lacking NextEra's sheer scale and their integrated capabilities across nuclear, gas, and renewables could face significant hurdles. Financing, project execution, compliance. It could lead to widespread project delays, or even distressed asset sales
That NextEra could then opportunistically acquire.
Exactly. So this isn't just about growth for NextEra. It's about potential strategic dominance in a market that's becoming increasingly constrained and complex. Again, just an idea, not advice.
Definitely not advice.
Okay.
So to recap this deep dive into NextEra Energy's Q2 2025 earnings call, we saw strong financial performance driven by both their stable utility, FPL, and that rapidly growing energy resources segment.
Right. Highlighted by those significant backlog additions, particularly in the really game-changing areas of renewables and storage. 30% storage backlog is huge.
And we explored management's strategic vision, meeting the nation's booming electricity demand across all sectors, leveraging that all-of-the-above approach.
Yeah, including that renewed focus on nuclear and gas, alongside their already leading renewables and storage build-out. Their ability to not just adapt, but actually thrive amidst regulatory complexities and capitalize on these big industry shifts, that really seems to set them apart.
Okay, just a reminder, this information is for educational purposes only. It is definitely not financial advice. As always, please do your own research and consult with a qualified financial professional before making any investment decisions.
Absolutely. So what stands out to you listening to this? We'd love to hear your thoughts, any questions you might have about NextEra or the call.
Thank you for joining us for this deep dive. We hope this exploration has given you a useful shortcut to being well-informed and maybe sparked a few aha moments about the energy transition. Until next time.